Okay. Hey there, everybody. Straight up 10 o'clock. Let's get started. Okay. Hold on.
If you think all olive oil is the same.
Okay. So let me tell you what we're going to do, and then we'll do it, and then we'll get on with our Sundays. I'm Paul Rabalais. I'm an estate planning attorney. I'm like pretty much most of the other people, just kind of cooped up in the home for now. Maybe I'll start with why Sunday. So that's the first thing my wife asked me when she learned I was doing this on a Sunday. It was, I had planned 5 of these YouTube live presentations on 5 different days, Monday through Friday of next week. And then I thought to myself, well, after I planned those, I got to do something on tax. It's a question we get often. So I plugged it in today. In addition, today would have been my dad's 93rd birthday. He was into tax after he retired as an engineer. He went and worked for H&R Block. He knew the tax code backwards and forwards. So I said, why not do it on April 26th? So here we are, plus we're at home anyway. Just a few little rules. Good thing about this is while we often get some viewers live, which we are, most of the viewings of this will be after the live presentation because YouTube records it and then they put it on my Rabalais Estate Planning YouTube channel. And then, anybody can view it anytime as long as they, search and find it in YouTube. So that's really neat. A couple of other things that are important. I want to give you the opportunity to be one of those elite people who, smash the like button. And, not everybody, maybe only about 10 or 20% of you elite people will be hitting the like button. So feel free to do that. It helps our channel get noticed more by people who go on YouTube and look for this kind of information. So now or during the presentation, if you could hit that like button, that would be great. Also, feel free, if there's a red subscribe button, you could join the 5,500 plus people who have already subscribed to our channel. So again, you know what? My microphone was far away. This ought to be better if you were having bad audio. Here it is. Okay, so, and again, 1 or 2 more housekeeping items. There's some chat. Feel free to type in the chat. The ideal chat message is, fairly, the grammar is pretty good at or better. It may be on point to what we're talking about or at least related. Positive, comments are best. And so feel free to type in the chat box. It's one of the benefits of doing something like this live is so that I can address any questions that come up. So like I said, that I don't remember exactly the title, but my goal here is to help you identify certain issues related to the tax aspects of protecting what you have if you're married, leaving things for your spouse, and if you have children, leaving things for your children, and not even necessarily to children, other heirs, how to minimize the tax effect of all of that. And again, I'll answer questions a lot of ways along the way. So as we talk about it, you'll hear me talk about different kinds of tax that we have that affect people when they attempt to try to keep and leave what they've acquired during their lifetime to others. So we'll be talking about the estate and gift tax. We'll be talking about the income tax. We'll be talking about the capital gains tax. And then at the end, I'm going to give you a few strategies, some of which are not too well known, that can save your family, significant Uncle Sam dollars when it comes to, leaving and obtaining an inheritance the right way. So I'll start with some stuff that's kind of dry. A lot of people know it, feel like it doesn't apply to them. And then we'll progress towards stuff that really would apply to anybody, regardless of what you have and who you plan to leave it to. So let's jump in. Most people, when we talk about tax and estate planning, most people think of the estate tax first. That's the one where when I bring it up, most people say, well, we ain't got to worry about that. Let's move on. And that may be true for many. And quite frankly, it is true for many. There's a few out there that don't think it will apply to them, but it will for reasons I'll talk about here in a minute. But the way our estate and gift tax system works, it's a unified kind of, we don't have an estate tax and a gift tax. We have a unified gift and estate tax structure. And really this YouTube live format only permits me to do the talking head video. I can't show you screens or anything. But we'll make the best of it. So the way it works, and again, in about a minute, you're probably going to say, well, that doesn't apply to me, and that's okay. And we'll move on to the next thing that does apply to you. For people who pass away in this year, 2020, the first $11.58 million of assets that they own are exempt from the 40% estate tax. So there you go. Now you're saying, well, heck, that's be a nice problem to have, but I don't have it. So there's no tax consequences. Well, there are tax consequences. It just may not be estate and gift tax consequences. But as we dig a little deeper into the estate and gift tax, I use the word unified a few times because people can use their $11.58 million estate tax exemption either during their lifetime by giving assets away or at their death by leaving assets to others. So let me give you an example. Let's say dad wants to help out his son who wants to buy a house. Dad says, you know what? I've got some money I don't need. I'd like to help you put a down payment on the house. Here's $100,000. Go use that as the down payment on your home. So dad writes son a check for $100,000. Now let's talk about what are the estate and gift tax consequences of that. Well, the first $15,000 that dad gives anyone in a year is exempt from this estate and gift tax calculation. So dad gave $100,000 away. So what all of that means is dad made an $85,000 taxable gift. And when somebody hears they made an $85,000 taxable gift, that somebody thinks somebody owes the IRS, but that's not true. Because really, since we have this unified estate and gift tax structure, dad, by giving his son $100,000 and making an $85,000 taxable gift, $100,000 minus $15,000, really all dad did was he started to use, before he died, he started to use some of his $11.58 million estate tax exemption. So now when dad dies later, he can only leave $11.58 million minus $85,000 free of the 40% federal estate tax. So that ought to give you enough knowledge to know that not everybody, too many people think if I give more than $15,000 to somebody in a year, people think either the donor has to pay tax, the donee has to pay tax, but really nobody has to pay tax. The donor just started using up some of their estate tax exemption. Yes, they have to report that gift on a federal gift tax return. You can ask Mr. Google to help you find it. It's called IRS Form 709. That's the gift tax return. But when dad made that $100,000 gift to son, let's say he did it in 2019, and so he'd have to report that gift on his gift tax return. It's not part of the income tax return. It's a separate gift tax return, but there'd be no tax due as a result of that gift because he still has a whopping 11 point something million dollars of gift and estate tax exemption remaining. Okay. Here we go. Moving on. So with that being said, a couple of other points on the estate and gift tax before I move into income tax and capital gains tax. This, I called it an $11.58 million estate tax exemption. It goes up every year. It's adjusted for inflation. In 2019, it was 11.4 million. And it's going to keep going up and being adjusted for inflation. So who knows? Next year, it might be 11.7 something million dollars. However, on January 1st, 2026, see this estate tax law, they really increased the exemption, but it only lasts for 10 years. So that tax law will sunset on January 1st, 2026. and it'll come back to where the exemption amount will be $5 million adjusted for inflation. I predict the adjustment for inflation it will be about a $6 million exemption on January 1st, 2026. So again, still won't affect most people, but you wealthier folks out there who may be in that $5 million range and may be saying right now, I don't have to worry about the estate tax, especially since the stock market's falling or has fallen recently and maybe on its way back. Who knows? Some people with roughly a $5 million estate may say, oh, 11.58 million? Let's move on. Don't have to talk about that. But they're probably going to live another 6 years or so, hopefully. And when they pass away, that exemption may be $6 million, or it may be less, depending upon what the president and Congress do. Who knows where we're heading with all this craziness and the coronavirus and our federal government spending trillions and trillions of dollars. Who knows what they're going to do with the estate tax in the future? So it's something we've got to keep an eye on. Years ago, the estate tax exemption was only $600,000. So today that would affect many, many people who just own a house and maybe an IRA. Their estates would likely be subject to estate tax. So by the way, everything you own is subject to the estate tax, your house, your real estate, your financial accounts, your IRAs, your life insurance, if you're the owner, traditional Roth IRAs, 401k accounts, if you still have one with your employer or former employer, savings bonds, even if you have expensive artwork and all those things, really everything you own, even if it doesn't go through the probate process, if you have, if you own it and possess that control, and there's definitions for that, it's going to be part of your estate that's subject to the estate tax. Real quick, another rule on the estate tax before I move on to the income tax, the capital gains tax, is we have some special rules where if you're a married couple, you can arrange things so that regardless of the size of the estate, there's zero tax due until both spouses pass away. The rule that we have is called the estate tax marital deduction. So it allows your estate to get a deduction for anything you leave to your spouse or for your spouse in a certain way. So if mega rich dad has $20 million and he dies and he leaves it to his wife, his gross estate is $20 million, but his net estate is zero because he took advantage of the marital deduction, left his estate to his spouse. Now she'll have a problem when she dies later and she doesn't have a spouse to leave things to. Then that's when the estate tax would, in theory, be due. Okay, enough on that. If you have questions about the estate and gift tax, chat box is the way to go. All right. Good question coming from, hey, I got to applaud just the people who are putting something in the chat box. We don't get a lot of chat stuff, so I'm going to celebrate by putting stuff in the chat box. Not sure what Mike Knife was referring to, but DKS, great. One of your favorite channels, awesome. Let's look at what you got here. My two married daughters, age 35, are reluctant to be my trustee. I don't know what to do. They will take the money though. Good question. I don't understand why they would be reluctant to be, and I'm assuming you're talking about being the successor trustee of your trust, because a lot of people, and we'll get to this in more depth in perhaps the YouTube Live tomorrow and later this week. You can check the schedule there, where we start talking about trusts and people having trust to make it easier to leave things to their family. So maybe DKS, you can tell me if this is helpful. Daughters reluctant to be your successor trustee. They will take the money though. So maybe there's an education process that might be helpful, because if dad is leaving things in a trust to two daughters, and they're not willing to be the trustee and oversee that distribution of things of what you have to your two daughters, whether it would be one of them as a trustee or both of them as co-trustees, now you got to go look to somebody else to be the trustee of your trust when you die. And there's likely to be, considerable expense involved with that, because now you have a third party involved. They're certainly not going to want to be the trustee unless they're compensated. And that's going to, diminish what your daughters will receive. So if your daughters are the trustee or trustees of that trust, literally 100% of what you have will go to them. And if it's the kind of revocable living trust that, we talk about a lot and is talked about a lot, avoiding all the probate and all the court and attorney involvement, and you set it up right, then the effort required of them is minimal, because they'll have immediate access to things to be able to divide it up among the two of them. So there really should be a financial incentive, no fees incurred to a third party trustee, more control over how they will receive the inheritance. For example, maybe you have a home and they want to sell the home right away or keep the home and rent it. All those things are decisions that a successor trustee or co-trustees make. There you go. Schwab charges $5,000 a year. And Schwab, they're likely to charge a percentage of the overall trust assets as well. And when a Schwab is a trustee of, and included in the trust is a home and real estate, then it really starts getting awkward and cumbersome. Yes, Schwab can handle the money and the investments fairly easily, but it's very difficult for them to handle other assets. So making a corporate institution like Schwab a successor trustee of your trust, it's just cumbersome. So who knows, maybe your daughters watch this video and realize that it may be in their best interest to be the trustees, and I'm just speculating as to what's going through their mind as you contemplate this with them. Okay, so now I'm going to say we're finished, and although we're never really finished, with the estate and gift tax component of this YouTube live presentation. Want to encourage you, smash the like button if you felt like that had any value whatsoever. Go ahead and do that. That'll help YouTube send my videos to more people, and that's what we want. So make sure. Looks like there's 27 of you at the moment watching, probably hundreds of you after we finish. Be one of the elite who smashes the like button. Okay, moving on to the income tax. So really, what we just concluded with the estate and gift tax is that most families won't have any kind of estate and gift tax consequences. They may have some gift tax consequences if they make gifts to their children or others of gifts in excess of $15,000 in a calendar year. You got to report those gifts, but you don't have to pay any tax, nor does the donate. All right, moving on, income tax. And I'd say just about every estate has income tax consequences. So let me start with the basics, and then I'll go through the exceptions, because it's never as easy as just, I can't cover it in one sentence. But the first sentence I'll start with, thanks, Elliot. Hey, Elliot, yeah, thanks for smashing the button. First sentence I'll start with is generally an inheritance is free of income tax. So let me give you a couple examples, and then we'll go into some of the exceptions. Let's say dad has a bank account, and in his bank account, he may have a checking account, he may have a savings account, he may have a CD, and the total of his bank accounts is $100,000. He has two heirs, he leaves it to his kids. Each child, after he dies, gets $50,000. That $50,000 that each child got from dad's bank accounts, that is free of income tax under the rule that generally an inheritance is free of income tax. So now I guess we'll get into some of the exceptions. So many people, I'd say maybe 90% of people who pass away these days, they have a traditional IRA. And the reason so many people have traditional IRAs is because they worked for an employer during their working years, and they accumulated a 401k account. And then when they retired, they rolled over their 401k account into their traditional IRA. And most traditional IRA owners, they just take out the required distribution unless they need more to live off of. So it's likely that when they die, they still have a balance in their traditional IRA. And I think most people, and that when they die and that IRA balance is left to their beneficiaries, the beneficiaries will pay income tax on distributions from that IRA. And there's a lot of different rules. I don't want to get into it too much with this new Secure Act. There's a lot been written and said, even by me on other videos that I've made, and I've made over 400 videos on the detailed provisions of the Secure Act, which affects the distribution requirements of an IRA when an IRA owner died on or after January 1st of 2020. Quick overview: if an IRA owner died before January 1st, 2020, the beneficiary could take taxable distributions over their remaining life expectancy. The new rule, the beneficiary must take out all of those distributions from their inherited IRA within 10 years after the IRA owner dies. So it's going to speed up when the money comes out of the IRA. More to the government. My goodness, they're going to need it with all the money they're giving out, but this isn't a political discussion, so I won't go there. And so anyway, my point there is anytime you inherit a traditional IRA, you're going to have to pay income tax on distributions from that IRA. That money will move, those funds will move from the IRA owner's traditional IRA to your inherited IRA, and then you'll take the money out not any later than 10 years after the IRA owner died. So just another quick example. Dad died. He had a $300,000 traditional IRA. He had 3 kids, 3 beneficiaries, because the IRA goes to whoever the designated beneficiaries are on the financial institution's IRA paperwork, beneficiary designation form. Even if Dad had a will that says, I leave my entire estate to the local zoo, the IRA is going to go to whoever's named as the beneficiary. So if he had named his 3 kids as the beneficiaries, the IRA is going to go to those beneficiaries. So after Dad dies, $300,000 IRA, 3 new accounts set up. I'll call them inherited IRAs, one for child A, child B, child C. $100,000 goes into each inherited IRA account. Kids can take the money out whenever they want to. They'll pay income tax on it when they take it out of their inherited IRA. They got to take it out within 10 years. All right. And there's different rules for when spouses are beneficiaries and whatnot. Okay. All right. So got to be aware, you may hear an inheritance is tax-free, but if you inherit a traditional IRA, and I keep saying traditional IRA as opposed to Roth IRA, because a Roth IRA after-tax money went into the Roth IRA, so it comes out income tax-free to the beneficiary. So traditional IRAs are the ones that get you. Other income tax consequences that have to do with estate planning is, all right. Hey, thank you, A. Prandle. Got to really celebrate these chats. So really appreciate the wealth of information from your channel. I'm expanding my current practice in Tennessee to include estate planning. Great. You'll learn a lot from my videos, not really tooting my horn, but 400 videos, all that stuff that they don't teach you in law school, that you won't learn by going to CLEs. You can catch that from those videos. So because the stuff in my videos is typically sample conversations that I've had over and over and over and over with prospective clients and clients. So good luck to you, A. Prandle in Tennessee. All right. Good to hear from you. Okay. So other income tax consequences. A lot of people, right, wrong, or indifferent, they these days own annuities. And again, we're not going to talk about pros and cons. And you hear some people say annuities are great. You hear some people bashing annuities. But the fact is, many people own annuities. And I'm really referring to what I'll call deferred annuities. And I don't want to get into the details of it, but sometimes, grandma goes to the bank. She's got money in her savings account. She's got money in her CDs. The banker walks her over to the desk, to the annuity person. She puts $100,000 into an annuity, and that grows over time. And whenever the money comes out of that annuity, let's say years later, $130,000 is what the annuity grew to. And either grandma takes the $130,000 out of the annuity, or grandma dies, and the beneficiary, for lack of a better term, cashes in the annuity, that gain is subject to income tax to whoever received that money. So the gain is $30,000. The difference between what Granny, I'll call her Grandma, I'll call her Granny, what Grandma put into the annuity and what it grew to, and from the time that it was put into the annuity and then taken out. So just be aware there's income tax consequences to being a beneficiary of an annuity. Maybe not as significant as being a beneficiary of a traditional IRA, where the entire amount that you get is subject to income tax, but there is some income tax consequences. I've had many people come back to me, 6 months after, a relative died, and they did all the annuity business and they cashed it in, and they realized there's a big tax bill to pay. The other thing that you have to be aware of is, in most situations, when a person dies, there's a final income tax return that has to be filed, and sometimes tax has to be paid with that. So let's say mom died in December. She had income let's say she died in December of 2019, and she had income. She had investment income, and she had perhaps pension income, and she had other income from January 2019 till December of 2019 when she died. Well, even though she died, there's still a final income tax return that must be paid on her behalf. And so sometimes, not too good when the family disperses all the money out, and then they forget, needed to file mom's final income tax return. And sometimes I got to go back to the family members and say, hey, can I get some of that money back? Because I want to make sure mom's income tax return requirements are met. And then sometimes an estate, here's where it gets confusing. Sometimes an estate has to file an income tax return. I'm not talking about the federal estate tax return. Estate tax is due on the fair market value of what someone owns when they die. I'm talking about an estate's income tax return. Let's say dad died. He had an $8 million estate, and he died on January 1st of 2019. And the estate didn't get settled, probate, this, that, information, complicated, lawyers. State didn't get settled for 2.5 years later. Well, all the time from the date dad died, January 1st, 2019, until the assets get dispersed to the heirs, which could be in 2021 or later, that estate has income. And income tax has to be paid on that estate income. In fact, typically an estate pays income tax at much higher rates than individuals pay income tax. So it really behooves the people in charge of the estate to try to get all of that settled as quickly as possible of individuals and trusts and estates. But generally estates pay income tax at higher rates than individuals. Okay, so the one where I'm going to talk about a lot of strategies that exist I hadn't got to it yet. It's the capital gains tax. A lot of not well-known strategies I'm going to get to. Let me look here and see. I like your question, DKS, and really I would like for other people to answer it. Do you all think the lockdown will end our country? I do. Okay, that's. I'm a glass half full kind of guy, I got to tell you, and this is a mess we're going through, but I think we're a great country of people. We're going to adapt, and we're going to learn, and we're going to make some mistakes, and we're going to move forward, and we're going to come out better on the back end. And that's just how I feel, and positive guy. But would like to hear everybody else's comments on whether you think the lockdown will end our country. Okay, and I don't want to get into all the political stuff anyway. That's a topic for another discussion. Okay, thanks, David, for the awesome advice as always. Comment. I would not love to go back to all my siblings and ask for some tax money. Ha ha ha, a lead balloon. I'm not sure what a lead balloon means, but I get your point. And just on that note, if you ever are so fortunate or unfortunate to be the person in charge of settling an estate, You always, even if it's a piece of cake, things go quickly, there's no problem. Just about every estate we handle that, has a fair amount of money, and let's say dad died, he has $1 million, and within, 6 months, ready to disperse everything to the 3 kids. So normally you think they'd each get around $333,000. So just a little side note here, every situation I would tell that executor or trustee, you know what? You never know if some unknown liability might pop up. Maybe the IRS comes calling. Maybe a medical bill comes calling. Maybe this, that, or the other might happen. And so I'll tell you what, why don't you distribute it all except for, and I'll plug in a number, $10,000, $25,000, $50,000, kind of depends on the potential stuff that's out there. And then let that money just sit in an estate or a trust account for 6 months, a year. And then when we're certain nothing's going to pop up, distribute the rest of it. So good advice for someone if you're in charge of settling an estate. All right. You know what? I planned on this thing going about 20 minutes. Here we are 30 minutes into it. But, I'm giving you some free bonus material here and really starting to get into the good stuff. All right. Capital gains tax. This one's important. Most people think they understand all of it, but most people don't understand the stuff I'm going to tell you here in a couple of minutes on the back end and some of the planning strategies, because the planning strategies that I'm about to tell you that will help your family avoid tax in the future, they made no sense just a few years ago. All right. So the capital gains tax, tough one, but let's start with the basics. Capital gains tax is generally due when an appreciated asset is sold. So if there's not a sale, there's no capital gains tax. All right, so let me give you an example. Dad bought a share of stock 10 years ago, and he bought a share of stock for $10. Maybe it was Apple stock. Maybe it was ABC Inc. stock. Doesn't matter. And he just sat on that share of stock for 10 years. And then he died last week when the share of stock was worth $50. So it had grown from $10 to when he bought it 10 years ago, or whatever I said it was, to $50 last week when he died. Here's the deal. If Dad would have sold that stock before he died when it was worth $50, he would have had $40 of capital gain, and he would have paid, let's call it 25% state and federal capital gains tax on that $40 of capital gain. And so he would have paid $10 of tax, and he would have received $50, $40 of capital gain, $10 of tax due to the IRS because Dad sold it before he died. Okay, and now let's look at another example. Let's say Dad didn't sell that share of stock and he just left it to his wife, his kids. It doesn't matter who he left it to. When he died, regardless of who he left it to, that share of stock gets a step up in basis. And so before he died, the basis was $10, which means when it's sold, all of that appreciation is subject to capital gains tax. But he didn't sell it. He died. And as a result of Dad owning appreciated assets when he died, all of that previous appreciation just goes away untaxed, never will be taxed. The new basis for that share of stock is $50, the value of that share of stock on the date that Dad died, which was last week. Okay, so that when people start to understand that, they think, okay, I think I got it. And that actually sounds like a good thing, because it is. And then I'm going to take it a step further. Let's say Dad left that share of stock to Mom, and Mom lives another 5 years. And when Mom dies, that same share of stock, it had appreciated from $10 when Dad bought it 10 years ago to $50 when Dad died last week to $100 when Mom dies 5 years later. Well, because Mom owned that share of stock, she inherited it from Dad. Mom, that share of stock gets another step up in basis when she attempts to leave, or when she does leave it to the kids. So all of that appreciation from $50 to $100 goes completely away, untaxed. Children get that share of stock for $100. Let's say there's 2 kids. They sell that share for $100 right after mom dies. They pay no capital gains tax. And in that circumstance, there was what I'll talk about in a minute, the double step up in basis. So that's, if I want to make you aware of a strategy, it's going to be this double step up in basis for married couples. That I'll get to the strategy when I finish kind of going over everything else. All right, let me get to, okay, there you go. Great observation. And I've just read the first couple of lines. PA, you got it. Lots of folks with AB Trust from years ago that stand to lose the step up in basis. According to Q-tips, they probably can't even, great point there. It's what I was getting at. Okay, so let me, that is, you may not know it, but that's the exact example I wanted to demonstrate. And you're going to have to stay with me on this. You may even have to rewatch this video after we finish. But the ideal scenario, the double step up in basis. When dad died, let's take a kind of a typical traditional family, dad, mom, 2 kids. And dad dies first, and he has appreciated assets. And when dad dies, traditionally, dad would leave his estate to something called a Q-tip trust. And I'm not going to get into what Q-tip means, qualified terminable interest property. Don't need to know all that. But he left his stuff to a trust. Either there was a trust that was part of his will, or he had a living trust already set up. Either way. But the reason traditionally the dads of the world who wanted to set things up the right way, the reason they often left their estates to a trust for the benefit of his wife, but when his wife dies, it reverts back to his children, where she doesn't own those assets after dad dies. It's in a trust, and she'll get benefits from that, like the income and the ability to use the principal for her needs. And then when she dies, it must go back to his kids. The reason that was so common, in fact, done just almost every single time in the old days just a few years ago and before that, was dad did it that way when we had a $600,000 exemption, because dad didn't want to lump all of his estate's assets into mom's estate. Because if he just piled his assets into mom's estate, then she'd have a large estate and there'd be estate tax due when she died later. So dad would say, or dad's lawyer would say to dad, here's what you should do. You should leave your estate to a trust. Mom can be the trustee. Mom can get the income. Mom can use the principal. But it's already set up that when mom dies, the trust assets must revert to the kids. And then dad's assets do not go into mom's estate. And that was the way it has been done for decades, and is still being done by lawyers who just continue to do what they've always done for the last 30 years. But the problem with that is there's not an estate tax worry anymore, because if dad leaves everything to mom, mom's still not going to have anywhere near 11.58 million. So it's okay if dad's assets get lumped into mom's estate. But mom's estate assets will only get another step up in basis if the assets are in her estate when she dies. So we've gone from keep dad's assets out of mom's estate in order to avoid estate tax on those assets when mom dies, to we've completely changed the typical planning to avoid tax to we want dad's assets included in mom's estate, because they'll get another step up in basis if they're included in mom's estate. And there's no harm in them being in mom's estate, because mom's estate won't be over $11.58 million, which is the estate tax exemption today. So if you pick up one thing from this presentation, it's that right there. It's just understanding the distinction on how a married person can leave things to their spouse to really eliminate the most amount of tax. Now, that's where we have to analyze things. You know, what is the size of the estate? And then there's non-tax considerations as well. You know, blended families, maybe a husband and wife each have children of their own, and that impacts how they leave things to each other and to their children. So it's not a completely tax-driven decision, but it can have significant tax consequences, particularly if there is appreciation from the time that the first spouse dies until the time that the second spouse dies. Okay, so taking a glance here at some of the chat, you're right, Barbara F. I did not mention portability. That is I am so glad, Barbara F., you mentioned that, because again, this is a little bit higher end than basic stuff, but I'm going to see, and you can tell me in the comments whether you're with me here. And keep in the back of your mind, and this is just addressing Barbara F.'s comment on portability. Keep in mind that the estate tax exemption, which is $11.58 million now, is going to revert back to about $6 million in 2026. So let's say dad and mom together have an $8 million, let's call it a $5 million estate. And let's say it's community property, so that, and I say that because each one then has a $2.5 million estate. And dad dies, he leaves everything to mom. Now mom has $5 million, and she's thinking, no problem, because there's an $11.58 million exemption. Well, there is a potential problem, because in 2026, the exemption is going to be $6 million. Mom has $5 million today. It's likely going to appreciate to more than $6 million when she dies after January 1st of 2026. So what dad could have done is, or dad's estate, which really means mom could have done it after dad died. She's probably the executor of his will. Dad's estate, when he died, and this portability thing, kind of new, maybe 5 or 6 years old, probably more, don't remember. But when dad died, there was no requirement that his estate file an estate tax return. His estate was well under $11.58 million. He had a $2.5 million estate. No requirement that an estate tax return be filed. However, probably a really good idea to file the estate tax return, because on that estate tax return, his estate, mom as the executor, could make an election, because dad only had a $2.5 million estate and he had $11.5 million exemption. So at a minimum, I don't want to get into this too much, but at a minimum, he has $9 million of unused estate tax exemption. And if dad's estate files an estate tax return and makes the portability election on it, then mom will have her $6 million exemption when she dies in 2026. And she'll also be able to add on top of that the $9 million of exemption that dad didn't use when he died, giving mom a $15 million exemption, almost guaranteeing that there's no way there's going to be some estate tax return when some estate tax due when mom died. Okay, so that one's a little bit more high end than just your basic stuff. If you got to go back and review it, I'm sure an hour or two after the video's over, YouTube will plop this thing on my channel. Feel free to go back and look at it. Okay. And I don't really, even higher end would be generation skipping transfer tax stuff. I'm not really going to get into that. I don't know what IOW. Okay, PA, you are on fire with your questions, I got to tell you. And so, but I'm not going to get into the generation skipping transfer stuff. My 20-minute webinar is now 43 minutes, and I'm really just talking the basics. Okay. And I will just say that the generation skipping transfer tax, just some quick theory. And this is really for the wealthy folks, but you know, if it doesn't apply to you, good to have the knowledge. The government doesn't, for the wealthy folks, you know, they want grandpa to leave his wealth to grandpa's children. And when grandpa dies, the government collects its estate tax. And then now the children own it. And then when the children die, leaving it to their children, the government gets to collect another collection of estate tax when the children die, leaving that wealth to the children's children. And so the government, or our tax code essentially discourages people, grandfather, for example, from skipping the children and leaving his estate, his large estate, directly to the grandchildren. Because if grandpa leaves his estate directly to the grandchildren, then the government won't collect any of the estate tax when the children die. So there's extra generation skipping transfer tax. It's a complicated tax. Quite frankly, I don't even see it applied too much. And so I'll do something on that in another video. But and I appreciate your understanding, PA. Okay, so where we're at here, the summary is maybe 4 or 5 important points. We have an estate and gift tax. Quite frankly, most people aren't affected by it. More people will be affected by it in 2026 and beyond. They might change it before then. Who knows? Stay in tune with this channel. We'll keep you posted. Number 2, smash the like button. YouTube algorithms will love that. They'll show my YouTube videos to more people. It's the only thing I'm asking you to do today. And you can be one of those, elite who subscribe to the channel as well, along with the 5,500 or so who have subscribed already. So you get the estate and gift tax. The income tax, generally inheritance is free of income tax. There's exceptions with traditional IRAs, with annuities. A deceased final income tax return also often has to be filed. And if an estate has income after the person died, that estate must file income tax. Got to be aware of all that. Be very careful if you're in charge of an estate from distributing all of the money too quickly when something unforeseen or unknown may pop up where you'd have to go ask the heirs to give you some of the money back. That's no fun. And then the capital gains tax, that's really where you can take advantage of some strategies, particularly if you're married, to leave your estate the right way. You see some people leave ownership of, in very simple terms, some married people leave ownership of their estate to their spouse. And quite frankly, that is a phenomenal way to do it from a double step up in basis standpoint. But there's non-tax considerations. You may not want to leave ownership of your estate to your spouse because, bluntly, your spouse might get remarried and leave your estate, what was your estate, to the new spouse. So all that plays into those decisions of married people. How do you want to leave things to your surviving spouse? And then realizing that the traditional way to leave things to a spouse in an attempt to avoid estate tax on what was $600,000 exemption, all that has morphed into leaving it to the surviving spouse in some form to get the double step up in basis. All right. So if you got any chat questions, feel free to, now's your last chance, because we're about to wind it up tomorrow. You all need to come back because I have a video of my 400 videos. The one that has been watched the most, over 100,000 times, has to do with some of the mistakes being made when people set up a living trust. And I'm going to focus on not only the content in that video, but other content as well. And, really talk about, when living trusts go wrong. Everybody seems to want to talk about all the great things about living trusts: avoid probate, avoid expense, avoid attorney, avoid court involvement, privacy, and all those things can be very, very true. I want to look at it at the other angle. So when things go wrong, what was it? So you don't see a whole lot about that out on the internet. So I'm really going to focus on kind of what it is and what are the mistakes that can go wrong and how to make sure they don't go wrong in your circumstances. Okay, very good. We're going to wrap it up here. Y'all stay safe on a Sunday. We'll talk to you tomorrow at 10 a.m. If you want to revisit this YouTube live presentation, you'll see it on my channel. It takes YouTube a little while, I think, to put it on the channel, maybe an hour or two. And we'll see you tomorrow. Thanks, everybody, for your live chat comments. Those were awesome. Smash the like button, subscribe. See you tomorrow.